Okay, welcome to week 4, the last week of the class. Good news is no more chapters. Bad news is still more financials. So, key thing with financials is your staffing. And the key thing there is think about how many people you need to hire into your company. Now, you have the choice of either doing what we call W-2 people, which is employees of the company, or using contractors, which you pay with a 1099. We're talking here with staffing, just those people that are your employees. Good news is you get to tell them what to do. Bad news is now you get to pay part of their costs. And you have to pay them because they're going to have more rights than you do as the employer. So, first thing, think about how many people you're going to need and when you need them. Assume that you can flex your time. You can get part-time people if you need to. And the main thing that the Labor Department will look at is how much you're paying them and whether you're doing the right withholdings. Now, just like with sales, upper part, you're going to tell me what the job is, and then you're going to put in the number of people you need. For our purposes, you have to have at least one employee. Even if you're an LLC, we want to make sure that the company can support at least one person. So, at least one employee, all 3 years. Think about how many you're going to actually need. Now, in the lower part, you put in what you pay them annually. Not monthly, but annually. So, the minimum wage in the United States is $7.25. So I look for that you're paying people at least $15,000 to $16,000. In Florida, it's $8.10, which means $16,000 to $17,000. Well, where did I get those numbers? Average number of people work 40 hours a week times 52 weeks, 2,080 hours. Multiply that by your minimum wage. That's what the Labor Department's going to look at. I always tell people don't use those numbers even though it's legal. Think about the poverty line. Actually, the poverty line is $25,000 for a single person, $41,000 for a family of 4. So again, think about how much you're going to have to pay people. I like to see increases each year, at least for cost of living. So again, think about these things when you start putting in your salaries that you're going to pay people. But again, you have to be able to afford to pay them what you say. There's a guy in New York, not New York, but in Portland, that was paying everybody $70,000 a year. Everybody went nuts on him because they're going, well, why are we all making the same amount of money? We don't all do the same thing. So, again, you got to pay people what they expect. If you're not sure how much to pay them, look them up in the BLS.gov, Bureau of Labor Statistics, and you can get those numbers. Or just ask people. Look at Glassdoor. Look at job sites. But again, think about what you have to pay people, and again, pay a fair wage. Now, 2 other things you have to think about. Am I going to give benefits? Now, this is extra money you're kicking in to pay health insurance, life insurance, retirement, other things that you could be doing. You are not required to pay any. But you may have competitors that are providing benefits. If so, you may have to offer them. It's not unusual to have 5 or 10% of their salary in benefits. To them, it's an advantage because it comes out pre-tax for them. Otherwise, they've got to pay for it out of their own pocket, and that's after tax. So then you've got to up their salary to make them equivalent to maybe what somebody else is giving them in benefits, plus the tax side. So again, you have to think about, am I going to have to offer benefits? The other part is payroll tax. Now, legally, you have to withhold their federal tax, their state tax, their Social Security, and their Medicare. Now, as an employer, in other words, if they're your employee with a W-2, being paid by a W-2, you get to pay half their Social Security and half their Medicare. That adds up to about 7.65% of their pay. You have to withhold the rest of it from their side, but you get to pay half of it. This is one reason consultants will make a little bit more money, because they got to pay all this themselves. They kind of call it a self-employment tax. But it's not unusual to pay a consultant 10 to 20% more to make up for the part that you're kicking in. So the only thing to watch, once you hit 5 employees, you now get the opportunity to pay workman's compensation insurance and unemployment insurance, which will add about 5% to your payroll. So again, once you hit 5 employees, I'm going to be looking for that payroll tax to go up by at least 5%. In some states it's more, some it's less. You have to look. There's a website called payrolltaxes.com that goes through each of the states and tells you what their rules are. But again, it's going to be a little different for each state. Countries are different. In China, your payroll taxes are 44%, and it's got a lot of stuff in it, like full medical, housing, maternity insurance. There's lots of things in it. But in the U.S., we limit you to, the lowest you can go is 7.65. But again, every state's going to be a little bit different. Now, you don't pay any of their federal or state taxes. You're just pulling that out of their checks. So that's the first one. Second one is startup costs. Now, this is the money you're going to spend before your business plan starts. So you may have to set up your office. You may have to buy inventory. You may have to, rent commercial space and fix it up before you can start working. Well, that's all out-of-pocket money before your business can actually start operating. I've seen it as low as $100 and up to $600 million. Somebody was buying a cruise ship. But again, think about how much money is going to be out of your pocket before you can actually see customers, before they can walk in the door, or before you can go see them. What contracts do you have to have drafted? What agreements do you need? What inventory do you need to get in? Because you got to, again, can't sell what you don't have. So think about that. Now, two things to think about. Number one, how many things are long-term, and that's your facilities and your equipment. Those get depreciated. The government lets you write off some expenses. They basically say, we're going to help you save money for the future to replace this equipment. That's what's called depreciation. We give you an estimate here. For the facilities, only put in the full value of a building if you buy it. If you're not going to buy a building, you're going to lease it, just leave it at zero. Just make sure you have some rent or lease payments down in the lower part. But those first two categories are depreciation. In other words, equipment that's going to last more than a year, like your cars or trucks or your CD players, your computer. Well, the government doesn't say you can just write it all off. Well, they actually do, but they limit you. But they tell you you're going to have to replace it down the road, so we're going to help you save some money. And so they let you depreciate it. It's a non-cash expense that goes into your fixed expenses. Lets you save a little bit of money. The other thing is your working capital. What that is, that's the cash you're going to need until your company is self-sufficient or solvent. I tell the class there's the only difference between insolvent and bankruptcy is what the court tells you. If the court tells you you don't have any money, you're bankrupt. If you just run out of money, you're insolvent. You can still recover without worrying about the court looking over your shoulder. But you have to have money to make money or to get the company started. Well, we look at in the next tab over, the monthly income statement, we calculate your cash flow. And you want to find the largest negative over 3 years. That's going to be the working capital, or the money you need to have on hand over those 3 years in order to not be insolvent, in other words, to pay your bills. So that's what working capital is. That's going to give you a number. That is how much money you need to get started. And that's what you would be asking an investor or you'll be putting money in, and what's left is what you ask your investor. I look at that and I compare it with the assumptions tab. Again, watch that carefully because you need to make money. The rule of the class is that you have to make money by the end of your third year. So, again, look at these numbers and try to make sure that the company's moving in the right direction. Sales are going up, profits are going up, because again, all the investors are going to be caring about is revenue and profits. They want to, because again, where do they get paid back out of your profits? So if you need $1 million to start, and you're making $100,000 over 3 years, how are you going to pay that guy his $1 million back? And that's what we're trying to get at here is, if you need money, you're going to have to convince somebody that, hey, this is a good investment because you're going to get your money back with interest. Okay, that's and then you have your mastery assignment, which is pretty self-explanatory from the sheet, but you're going to just tell us about the class. So those are the things that are due this week, and then you're done. And you'll be moving on to final project and turning in your business plan and doing a presentation. So have fun in your last class. Appreciate you being with my class, and we'll see you at graduation.